All right, welcome back. This is part two of cash versus a policy loan for a slow flip. And so, a little bit of arm twisting. I decided to go ahead and show the numbers. So I've got some fancy calculators out here. Don't let it confuse you. It'll be overwhelming. I'll walk you through what you're seeing here. So first things first, we have two different accounts, right? We have a high yield savings account up here on the left. This high yield savings account is we're putting 45,000 in the first year, and then $10,000 a year in every year for 20 years. Okay, so this could be again, high yield savings account earning 4%. Notice here that over the course of 20 years, we earned $386,000. That number is indicated up there. Hopefully, it's large enough for you to see. I try to get both of these calculators on one screen. So 386, 381. But we also have to account for taxes. Okay, so taxes, I'm going to assume this individual is a 40-year-old individual in the 24% tax bracket. So we put in taxes there. And as you can see, that is a pretty good size eroder of wealth, right? So we went from 386 to 341 simply based on taxes. All right. So first thing we want to do is we want to take a loan. The moment we have 30,000 in our savings account, we want to take a loan. But before we even go there, let's make sure we recover some things that just important to understand about these types of accounts. Number one, limiting factor is taxes. We talked about that, right? Taxes are a eroder of one's wealth, right? And we're seeing that in real time, okay? So taxes is something we have to deal with. In fact, when we're talking about borrowing or using money from a savings account, put in the slow flip, all the profits go right back into the taxable vehicle, right? So it's a double taxation sort of situation, which is not favorable unless you like to donate to Uncle Sam on a regular basis, okay? So the other thing about these accounts, of course, is the unsustainable interest. We don't know how long that 4% is going to last. We all know that interest rates weren't this large not that long ago, for a very long time, and so it's likely subject to change. Let's just put it that way. So even though we're projecting 4%, the likelihood of that continuing to happen is unlikely. It may go up, likely go down. Just something you have to consider. Okay, so unsustainable interest rate. All right, interest and can't spell it. Interest rate. All right. Okay. Now, so first thing we want to do is we want to get that first loan. So we have $46,000 by the end of that year. Certainly, we could take a loan. So we take that first loan, $30,000. We take it in the first year. It is at we pay it off over 5 years at 12%. Let me take a look. Let me just show you something here. So if we pay it off at 0%, we're just paying that $6,000 back. Okay, this 558 represents what we could have earned because we're not earning because that money's taken out and we're paying it back in. Think of that number as the interest that could have been earned, right? Because the money's not inside the policy. Okay, but you can do the banking, right? You can do the infinite banking using a high yield savings account, right? The vehicle, you can use a traditional bank account to do this, to do the banking. In other words, infinite banking is really about the system, the process of being a good steward to yourself and paying back the cash flow into that vehicle. And so, in charging yourself what the market would have charged you. So in this case, a private money lender would have charged you 12%. So instead of $6,000, paying back $6,000 per year, let's go ahead and pay back the full amount of what could have gone back into the account had it been at 12%. Okay. So notice here, instead of 341, had we done no loans, because we're being a good steward of our bank, we have a future value with loans of 356. Pretty powerful. So if we do this systematically and consistently with no hiccups, we now look for an opportunity for our second loan. So that's the second year. Okay, we're just looking here to see when we have enough cash. And again, we have cash in the second year, enough for $30,000 loan. And so we do that. And we keep doing this over the years. Loan number 2, notice we're doubling up on the repayments into the bank account, right? We're speeding up the repayments of those those loans, kind of creating a snowball effect. Okay, and that's powerful because guess what? It gives you the opportunity to take another loan in year 3. All right. So we did next loan year 3 and then year 4. I only did 4 loans here, but notice that instead of 341, had we not taken any loans from the high yield savings account, we now have 397. Okay, not too shabby. 397 over the course of 20 years. All right, that's the power of being disciplined and paying that money back into your bank account with interest. Okay, with interest. But notice here again, I want to point this out. If we didn't have taxes on this account, look what we'd be. 444. 444 compared to a taxable account at 397. Okay. All right. So I'm going to put that down here. 397K in high yield savings account with loans. Okay. All right. Now let's look at the policy. The policy here is a 40-year-old, again, with $1.1 million of permanent death benefit. Okay, we can't ignore that fact. And because of that, there's an upfront cost. Notice here that we don't have access to all $45,000 of our premium. Again, we're putting $10,000 a year into the policy over the next 19 years for a total of 20 years, okay? So what happens is, notice here that we start off with, we have 374 if there are no loans. 374 with no loans, okay? So, but we also have to account for the fact that there are no taxes. No taxes. Okay, no taxes with IBC. All right, so we are waiting for our first opportunity, which we can do in the first year. We have 34,000. Remember, not the full 45, because we have to deal with, again, the fact that we have a big death benefit that we're funding, okay? Initially, we overcome that, but initially, that's what we have to overcome. We're trying to give you as much cash value back in your pocket as we can in the meantime. In this case, we have access to 34.5, and so therefore, we take our first loan, 30,000. We pay that back at 12%. Understand that the insurance company is charging us 5%. Okay, so we do have an arbitrage there if we're being a good steward to our bank and we're putting in extra that goes back to us. Okay, just like the high yield savings account, we're paying back extra. Okay, so we put that money back in and we go for the next loan. Can we do a loan in year number 2? We cannot. We don't have enough money there, and so we go to year number 3. So we do another loan in year number 3, $30,000, and we pay back over 5 years at 12%. Okay? Again, we're experiencing that arbitrage between the 5% that we're being charged and the 12% that we're paying in, which, again, creates that we're doubling up on repayments. It pays down the loan quicker, thus allowing us to have access to those funds quicker. All right? So we're looking for the next opportunity for a $30,000 loan that happens in year 4. So we take another loan, and we do that until we have 4 loans. Okay, notice here, our future value with loans is 432. 432. With loans. Okay, so let's kind of step back here for a moment and evaluate. So what we've talked about are this idea that, okay, we can do the infinite banking strategy. Again, it's just a strategy, it's a process with any vehicle, all right? It really comes down to the individual and your commitment to recycle that money back into the source with interest, just like you would find in the marketplace. Just doing that on your own personal level, okay? However, the vehicle matters. If you have an efficient vehicle that's not being taxed, that continues to grow, okay, guaranteed, okay, that's private and all these other things, okay, and we cannot discount the fact that we have $1.1 million for the rest of our life in death benefit. So in which scenario do you think the individual would be more inclined to spend down their assets in their golden years. The high yield savings account, where they had a term policy which went away, okay, became too expensive and they dropped, or the policy where they have 1.1 million in death benefit, where you feel more inclined. So you're not in a place of scarcity when you have a nest egg of money that's going to your heirs, that you can spend down. You feel more comfortable, more peace with yourself to be able to spend down assets if you know you've got a death benefit that's going to go to your heirs, okay, as opposed to having a savings account where you relied on term, that term is gone, and now you're hoping to have something left over to pass along as a legacy. Okay, so we cannot discount that fact, even though we don't bring it up very much when we're talking about this infinite banking. It's important to understand that is a part, especially as we get older and older, that's a part of the equation, and your ability to spend down your assets and to live the type of life that you want to live. Okay, this allows that. All right. So with that said, if you have questions, I invite you to ask them. And I know it's a lot of numbers here, but just understand that, again, takeaway here is that you can do the infinite banking process using a high yield savings account, or you could do it with an high cash value policy, dividend paying policy. The choice is, it just depends on how efficient do you want your system to be, and there's nothing stopping you from doing both. That's the beauty. There's nothing stopping you from doing both. With that said, when you control your income, you control your outcome to your prosperity. Thank you.